day all. Ira Epstein of Linn Associates with your agriculture wrap-up, and this is for Tuesday, the 21st of January, 2020, and we're just now getting after 2:10 p.m. Central Time. As you know, the Senate trial is on the impeachment. We're seeing that, but the events today are really in the grain market. First, we'll start with cotton, down 200 points. That's pretty big. Look at the energy markets, all getting hit. When you take a look at the soybeans, down 13 3/4. Now, the wheat was up. Wheat's got its own little issues going on. Russian farmers aren't really trying to sell that much wheat right now. Australia, as you know, you've got the fires. A lot of the wheat land areas there being burned out. U.S. farmers planted smaller acreage last year. We're looking to see what that does. So we're getting a goose up in the wheat prices, but nothing else. That nothing else is in part due to this coronavirus. And it's a form of, I guess, the SARS virus from 2002. Now, I'm not saying it's SARS. That's not what I'm saying at all. But this particular virus is spread human to human. Now, on Friday, we had seen that it had already been in Japan. Thailand, I believe, was one of the countries, South Korea, and of course, China. Well, today the U.S. is reporting that there's a case been discovered in Seattle, Washington. This is moving and moving quickly. This is the Chinese new lunar year. So when you get to that and people go on the move the way they do for Thanksgiving in the U.S. or other holidays, whoa, you're talking this disease can spread. And here's what people are worried about. As that comes aboard, nobody's buying things. Everybody's scared. That's what we saw in 2002. Look at the metals. What's the reason for them to be down today? Where the bid came in today were the bonds and notes, which I don't keep on this particular chart, but they're there. The Japanese yen also got another bid today, and energy's slowing down, grain slowing down. When we take a look at a weekly area chart of just closing prices on soybeans, you pulled right back to that 18-week average of closes, what I call that neutral number, that line in the sand. So it's finally done it. You're down 13 3/4 cents for the first day of the week. When we take a look at the daily bar chart, I had pointed out to you last week that this market had broken out to the downside. Now, the question, of course, was how far would it go? This was Wednesday, then we got to Thursday, and as you know, I don't show the daily charts on Friday. This is what the market did. You had an outside day up, and now you take out that low. That means you created a bull trap here. And when you create a bull trap, I look to see key numbers. So some of them are key moving averages. Well, I don't have them on this. I've got the swing line, which are lower highs, lower lows. Then I look at the key averages. We're under them. The only number that comes into play then is the lower Bollinger Band, and you're under it. I don't know where this market is going. In other words, it's broken out, and now the question is, it's sort of a panic mode for the moment. How deep is deep on the correction? Is it back into this zone, the 910 area? Could be. It's only 6 cents lower. In terms of momentum, we're very oversold. So as fast as you get nervous about these diseases and the impact it has, and will China be able to buy the products that they're supposed to under the U.S.-Chinese trade deal, and then you get a wild card thrown like this, you just don't know. And that's what we walked into right after this Martin Luther King Day. I only mention that because we weren't open yesterday. In the meal market, we're caught in the lower to the upper Bollinger Band. The market's still pointing its head down. You would negate the downtrend if prices could take out 302 on this particular chart, but until it's taken out, the trend is down. 298.40, the lower Bollinger Band, could be the re-challenge of that support zone. In the soy oil, down 60 points, and look at how much this market has given up. Now remember, the marketplace was talking that soy oil would be a big export item for the U.S., actually the bean because the Chinese need the oil, palm oil, I can go on with all the sunflower seeds, and of course cotton. Those are the markets. But when we go through the markets, you're going to see that everything's a bit lower. Even the corn market, lower highs, lower lows. Still a downtrend. To negate it, you got to take out 389.5. That would negate this downtrend. But what you're really doing is playing at the 18 and the 100-day average of closes, not moving to side anywhere. Each break has been met with good support. As you've gotten the lower Bollinger Band, you come running right back to the upside. So in this chart, we have momentum up, bias where market close 387.5 up, and the swing line down. You got a confusing chart. In the wheat market, you keep hitting the upper Bollinger Band, making new highs on the move. That's not to be lost. This is not a sideways pattern. This is an uptrend pattern that keeps hitting the upper band, getting over it, and then pulling back under it. I don't expect that to change until there's a change in the fundamentals. In the sugar market, you have an embedded reading. An embedded reading occurs when the slow stochastics move from overbought to locking in a trend with both numbers going over 90 for several days or more. You have that. And that tells me that on the breaks in the market, until that pattern is lost, the market's getting bought by the pros looking to see if they can re-challenge the upper Bollinger Band. Coffee's the flip-flop of the sugar. You've got the embedded reading bearish. And as you can see, the market keeps plugging away lower. Now, admittedly, this 111.87 is, let's call it that 100-day average. That seems to be a number the market hits, bounces, today back under it. If you want to accelerate and catch people, drive the market to the lower band. Over the holiday weekend, I was watching TV and I saw that now there's a plant-based coffee coming out of Seattle. And they asked the announcer to take a test, and he was able to pick which one, but he said it was excellent. I wonder if that's a threat to the actual coffee out there. In the cocoa market, an embedded reading to the upside. You just keep running. Again, you hit the bands, you pull back, you go up to the bands, you pull back. It's very typical of bull action in these markets, and until that red line's under 80, I look for support. We then get to the cotton, and the cotton market turned bearish today. You've got now lower highs, lower lows, the first close back under the 18-day average of closes. You have to go all the way back into here, December, to get that. Now, this was a market that we've been counting on a lot of export business, and it really ran up in price in a major fashion. Just think about it. You were in the 6,400 level. You got up to the 72 cent level, and you're finally getting a bit of a correction. Could it follow through even deeper? Of course. But I don't think that's going to change the fact that there will be cotton consumption out of China. The question is, did the market get ahead of itself? In the cattle market, last week just proves the point. Here's a sideways market. You see the Bollinger Bands. You go down, you hit the band, you think, okay, it's going to break out to the downside. Not only doesn't it, but you get these people caught. You haven't broken out. This is the hardest type of market to stay patient in. That's what you should be doing. Feeder cattle, the same thing. You're traveling from upper bands to basically lower bands and back to neutral. Yes, the overall trend in feeders is still to the downside. You have momentum down. You're at the 18-day average, slightly under it, and you have a market that still has downside bias. You negate that if you can get up here and take out the 146.15 level. That would break the pattern of lower highs, lower lows. Last, in the hog market, weren't we supposed to see China buying a lot of pork? Yesterday, which was Martin Luther King Day, I have a friend in Chicago, and they do an awful lot of ribs. That's their business, ribs. So they buy from the packer, they trim them for restaurants all over America, New Zealand, I can go on and on. Huge factory. So I wanted some ribs for myself. So I went there yesterday and they were open, and I went on the lines and all. You got to wear all your outfits and USDA approved, and they're all there. But we were talking and I said, I'm just not seeing it. I see the summer months about 10 cents higher than the nearby months, but where are the pork purchases? And he has said, is still finding products not the easiest thing, and they buy from all over as they trim their products for many of the big national chains. But it was interesting to hear somebody in the business doing that. And of course, I got great ribs. What can I tell you? So in looking at things, if you're a technician like I am, you should learn. Keep learning. That's what it's about. You never see something you haven't learned about. Okay, I'm always learning something new. And for your library, you might want to look at different chart patterns, have that. These are all things you print out within our technical guide to indicators put together by our good friends with me and Modern Trader magazine, the old Futures Magazine, and I think you will find that these articles are so good and they teach you the basics. It's about 20 pages to each booklet, full color. Ideally, you should print them out, keep it because you read it easier, but you can just read it right on your computer screen as well. Don't do it on your phone. It's a bit harder to read. How do you get this? And it's free from us. Go to our website, look at our free offerings. It'll be on the bottom right. You can always call my staff. They'll work with you. Or you can click up here. It'll take you right to that page. For those of you in Canada, I'll be on very shortly after this is out on BNN TV there talking about all these markets. You have a good day. I'm Ira Epstein.